Hey everyone, welcome back to the channel. Today we're going to just take a look at Airbnb again. So did a video on them probably about 2 months ago, valuation video, and I can pull up the old valuation here and we can see where we kind of landed. I think we were, let's see, about 50 billion valuation. Um, and you can see we had for 2020, so this was a projected pro forma, 520 million negative in 2020. If we look at kind of after their results came in, that's still showing 520 because that's not updated. So we'll update that in this video, and we can kind of compare back to where we landed versus what we expected. But first, to pull up their most recent 10K, go to sec.gov. You'll hit more search options and then search for their ticker, and then 10K. So you can see they filed this 226, which would have been, was that Friday? Friday. Um, go ahead and click here, and a lot of stuff in here, but we're really just for now concerned about financial statements, and we'll start with statement of operations. Here we can see their revenue was about 3.4 billion, and if we actually go back to our model, originally, so here's the original pro forma, and then here's how they actually landed. So my first video I projected about 3.3, so a little bit short. COGS was actually better than I anticipated, so gross profit was better, and you saw flow through on revenue there. And then most of these other things were very off. So like operations support, roughly there, right? Product development, I mean, you're almost 2 billion off. We were 9 months through, and they were at 700 million, and they finished the year at 2.7 billion. See something similar with sales and marketing, right? They were at 545, doubled it, almost tripled the G&A. Restructuring was right in line. So really, I mean, we were off by 3 billion in expenses and costs. And I started digging around a little bit on here, and what it is their, how do they spell it? Is it hyphened? Here's their stock-based comp table, 3 billion right here, 2020. And I'm going to guess this all hit Q4. Otherwise, we would have seen much higher numbers previously, but product development, 2 billion there, sales and marketing, G&A, and operations and support. So, I mean, in theory, we probably need to back this out in our model to get a fair representation of their free cash flow. Obviously, stock-based comp, it's a non-cash expense. You can argue that, you know, it's a real expense though, but for our purposes of just calculating a cash flow, it is non-cash based because they just issue equity, and sure, it dilutes you as a shareholder, but another topic for another day, I guess. So anyways, I updated this balance sheet. We didn't have working capital previously. They had like this line previously, but it doesn't tie to anything. Their new balance sheet, try to pull out current assets and current liabilities, you get negative working capital, right? Because all they have here is prepaids. The funds receivable and other amounts held is actually directly offset by funds payable to customers. So it's a net zero. My understanding is this just like you book an Airbnb, you pay Airbnb until your stay is complete. The host doesn't get paid, or they get paid partial. And then, you know what I mean? So these two, they book an asset and a liability for it, but really they have AP, accrued expenses, and unearned fees. And they just have very few prepaids. I think it's a little concerning though if we look at their accrued expenses. 700 million, 1.2 billion to 2.4 billion. If you're not familiar with accrual accounting, this is basically like we haven't been invoiced, but we know we've like used the service or whatever it is. So you accrue the expense. So you basically say like, oh, here's $2.4 billion of expenses, and you know, maybe this is just them growing as a company and now there's a lot more expenses in general, so they're accruing a lot more. Or is this, for whatever reason, them just trying to like in a sense, book a bunch of expenses. I don't know. Um, in the fiscal year, and they're like, we already have all the stock-based comp, so just accrue a bunch of stuff, and then we'll see a lot of favorability in 2021. There's some funny accounting stuff that can go on, um, but it's interesting how it's doubled every year. So be interesting to see if that continues. But we'll link up the model real quick. So unlevered free cash, or I guess first we need to, we're gonna actually plus stock-based comp. Oops. And I mean, hopefully we don't see a lot more stock-based comp in the future. But so for 18, is this the, so it's like 54 million, 98 million, 3 billion. Okay, so 2018 it was nine. 8. Let me make these different colors so I know, oops, that I manually input these myself. And then we need to update these formulas. So take our adjusted EBIT, add this, subtract this, add this. So that seems weird. What was their operating expenses? Their operating expenses was, I don't think I've updated the links here. That's what it is. Okay. So it's like their operating expenses was way higher than what that's showing. So let's link this up to 2020 on the income statement. And we can kind of see how they're trending now versus DNA actually have down here. So let's see. EBIT, add back DNA, less CapEx, and then change in working capital. So, okay. And that's, I mean, this is really their current assets just being nothing. They have very few prepaids and they just have a ton of accrued expenses. So I don't know. I don't think it should continue to grow. I think the dollar amount should probably stay similar here, and then prepaids. I don't like to give companies a lot of credit for working capital in their cash flow, but based off of this, it's saying a $4 billion free cash flow, and it seems kind of weird. I don't know. Let me see if they have. Do they like give us any metrics in here? Free cash flow. Yeah, no, I mean, their free cash flow here, they're saying is negative. So they're saying a net loss, but then we're backing out 3 billion for stock-based comp. They're saying adjusted EBITDA. I wonder if that has the, because what's our net loss? 4.6. Is that what they're showing? Yeah, they're showing the 4.6 adjusted EBITDA. Do they have a reconciling table here? Revenue, net loss, stock-based comp. They do adjust for it. And they have this other income that they're adjusting. So why is ours so, let me see, maybe something's not linked up correctly in my model. That's what it is. Got it. Okay. DNA, is this an EBIT? Giving a big credit there, 1.1. Let's see what their reconciling table says. Where did that just go? Adjusted EBITDA. So their adjusted EBITDA comes to 250. What's our EBITDA? Or I guess our adjusted EBIT. Let me see, free cash flow. 667. Where's the? So this is okay. So they have 700,000 or 600 million use of working capital. So that's what's weird. Can't really reconcile to their numbers. If we take the, I mean, let's see, what do they give us for working capital? We're just gonna scratch that. This is 595, 557, 222, 727, and then negative 629, 732. Okay. Is that that's already. So that's already the change. So paste those there. And now we're getting closer. So I mean, right there, free cash flow, 505, 97, negative 6. We're getting closer there, or I guess that's, yeah. Directionally, that's better. And obviously ours is kind of more of a high level synopsis. You could read through all their adjustments. I'm gonna guess they're adjusting for a lot more one-offs. And if we look at their income statement, it looked like they were, they had an adjustment here for other income. Saw a huge spike that. So we're not adjusting for some of these smaller things, but this should get us in a good enough spot to proxy out a valuation. So I think the first thing is we have to assume they're going to return to profitability, or not profitability, pre-pandemic revenue. Sorry, not profitability. And we're going to do that. So they're going to need to grow. Let's give them. There you go. So we'll say they're going to grow. They're going to get back to pre-pandemic revenue levels in 2021. Business is going to recover, and they're going to hold. I mean, COGS have stayed pretty close to 25%. We'll just leave those there. And let me actually just kind of copy these formulas across real quick. So hopefully we can just quickly fill out our assumptions, get a valuation, and see if there's any material changes. SG&A is a percent of sales, right? So I mean, we know 3 million of this was actually from stock comp, so we can guess that that's probably going away sooner than later. So I would say we actually want this probably closer to 3 here. Oops. So, yep. And we'll see how that looks as a portion of sales. And then we'll just kind of hold that. Oops. We'll hold that assumption flat for now. There we go, 61%. And we'll link this up real quick. And then once we enter our sales revenue, we'll see that actually grow. And then we can assume margin improvement or not. EBITDA. So yeah, we're saying they're gonna have positive EBITDA, so kind of back to 2018 levels. D&A will link in from below. Tax rate, just gonna hold it 21%. And that's actually probably, this is probably one of the bigger things that's the difference between our two. We have our tax taxes, effective tax rate. So we're giving them, when they have a huge loss, we're giving them a huge credit for that at a 21% tax rate, which is fine. Not the end of the world. Formatting got a little wonky there. EBIT, copy that over, and then DNA will get linked up from below. So this is sorry, this thing's looking a little janky now. There we go. And DNA again, we can just link it back up. CapEx, this is going to link below. And we'll go through here in a minute and just update all these kind of assumptions. Let's see, CapEx. They really cut CapEx there. That's crazy. Probably the first thing to get cut in the middle of this. And I mean, stock-based comp, I'm just going to leave this at like 100. Kind of where it was. I mean, I'm thinking they're going to take the way of the Googles of the world where they give you stock options every year, restricted stock units, something of that nature. We're going to have to figure out how to normalize all this crap, but I don't know. It's fine for now. I'm just going to hold it at 0. Cool. So it should be good now. Fill the stuff out and our model should complete sales growth. So, 80%, 50%, 40%, 30% pre-pandemic. So maybe we have them, once they get back up, we'll give them 30%. We'll have them decrease 5% a year until they're in the teens. And then once they're in the teens, we'll have it decrease 1% a year. I mean, this is going to make them a massive company, right? What, 20 billion by 2030? But who knows? If they're the largest provider of hotels, definitely possible. Or of stays, not hotels. They're not a hotel, but yeah. And then COGS, I'm going to leave constant at 25%. Just the nature of their business model is pretty good margin-wise. SG&A. So let's see, how does SG&A look right now? Operating expenses. So we have it slowly growing. I mean, that's probably fair. And then EBITDA. So yeah, I mean, they have positive EBITDA, which I guess is good. So CapEx as a percent of revenue, I think they have to get back up to like the 2.5% probably that they were pre-pandemic. My guess is they cut CapEx due to the pandemic, which, that's fine. Dandy, makes sense, but oh, and the scale's off here. There we go. So there's that, and that links up now, I believe. Did I get pulled in? Yep, CapEx. Depreciation as a percent of CapEx is going to have to go back to like 85%. Otherwise, they're not investing in growth CapEx, which I don't believe in. Especially if we're giving them credit for growing, then they're going to need to be investing in the business. So then this is a percent of CapEx. Once again, this is the format, but there we go. This actually needs to be a negative. There we go. Make those black. Cool. And this was actually an old metric from the first time we did the model. It's not needed anymore, but it is. Just link those formulas over. So we'll leave it like that for now, and this ignores working capital. I think their working capital is a mess based off what I can see on the the balance sheet. Um, I'm not sure how they're calculating it when they reconcile, but there's got to be some other current assets that I'm just missing. But with these assumptions of them returning to baseline, right, and then slowly growing, um, oof, not worth, not worth what they were showing. I guess if we increase our cost capital, even worse. Yeah, man. Net debt. I don't even know if we have net debt on here. What is it? They probably have debt on their balance sheet now. Let me see. Long-term debt. Here we go. 1.8 billion. Okay. And then how much cash do they have? They have a lot of cash. Yep. And so we actually want to subtract that, so that actually helps them. But yeah, you can see we're nowhere near their valuation. And let me pull up the model from last time. I think we were a lot more, we only did a 5-year DCF, but we gave them like 40% growth for 5 years. We had them, I guess they just provided like a free cash flow percentage, which made it a little strange in their prior model. So I mean, it's hard to really, that 50 billion, hard to really wrap your head behind. But let's say we leave this at 40 for a couple more years, and then we have them decrease by 5% a year. $60 billion company. So I mean, this is really going to be a story of top line growth and what you really believe there, right? And if we say 8%, this is the return you need, you're doing better. I mean, COGS I don't really see going down. If anything, I think COGS go up if they start like acquiring properties or something. SG&A though, I mean, maybe you say, you know, they're actually going to see slight improvement in SG&A. Product development costs go down, things of that nature. As the business gets better, that just really shot up their valuation. Yeah, wow. So I guess if you believe, I mean, you could probably go back to something like this now and still, yeah. So if you believe that they can control their costs, right? That seems to be the story here. Even if their revenue fizzles off and they only ever hit 25 billion in revenue, but if they can really control COGS, which I mean doesn't seem super likely, but let's see. So I mean historically they've been around 80%, right? But if we're saying there's 6 billion here, you take 3 billion of stock comp out, they're 4 billion here, probably had a little bit of stock comp in that number. So 3 billion is kind of like a baseline to operate the current business. And then it just kind of slowly becomes more efficient. Yeah, I don't know. They're still going to need, they're going to need good growth though, still, to be honest, when I look at this. You know, you're still going to need a high, mid double digits growth for 5 years, while improving margins, and that gets you to 115. And I mean, I think if we go to Yahoo, right, we can see what their current market cap is, and my guess is it's probably already more than that, 117. So, I mean, people are baking in continued growth and then just tons of cost cutting from the SG&A perspective. I mean, if we look at it, right, like product development, sales and marketing, you know, G&A, I don't know. It's an interesting story. We'll see. But yeah, I think I can see how you get to their current valuation. I don't really see a way to get above it. I think it would be hard to believe a story past that. Um, but definitely interesting to see their first 10K. As we get more financial statements, and if I actually take the time to read the full thing, maybe I can understand how they're getting their working capital numbers. And you could obviously model out like a rooms per night, an average nightly rate. You could do something like that and say, average nightly rate's actually going to go up, and that's how they're going to grow revenue, or they're going to keep more from the hosts, or whatever you want to call it. But I don't know, interesting to see after their first 10K came up. So yeah, I hope you found it interesting, and questions or comments, leave them below, and thanks for watching.